315 million ounces. That's what's left. 8 months ago, it was over 500 million. Someone is quietly emptying the vaults, while the price on your screen keeps falling. Nobody is explaining why. The banks aren't saying it, the financial news isn't saying it, but the vaults don't lie. And what's happening right now has only happened 5 times in the last 50 years. Every single time, what came next changed everything. Stay until the end, because the last 3 minutes of this video will show you something they really don't want you to see. Hello, and welcome back to the channel, John AG. Now, before we go any further, I want to ask you for something. Just one small thing. If you've been coming back here, video after video, and if what you're about to hear today helps you understand this market a little better, would you do an old man a favor? Just tap that subscribe button. It costs you nothing. It takes 2 seconds, but it means everything to a small channel trying to bring you the truth before the headlines catch up. And while you're at it, tell me something. Where are you watching this from today? Are you sitting at home in the evening, coffee in hand? Are you at your office, sneaking a look during a break? Type your city below. I read every single comment, and I would love to know how far this message is traveling. Now, let's get into it. In October of last year, the warehouses of COMEX in New York held something close to 531 million ounces of silver. It was a number nobody thought twice about. It was just there, sitting quietly, the way it always had. But numbers on a spreadsheet are not the same as metal in a room. And somewhere between October and now, someone started asking for that metal to be real. 8 months later, the number tells a different story. 315 million ounces remain. 216 million ounces are gone. Not lost, not misplaced, withdrawn. Someone walked in, showed their paperwork, and walked out with real silver bars. This is the part almost nobody is talking about, because at the exact same time this was happening, the price of silver was falling. It touched its lowest level in months. Anyone glancing at a chart would assume silver was in trouble, weak, unwanted, falling out of favor. But the vaults were saying the opposite. They were saying, people want this metal so badly, they are pulling it out of the ground floor of the financial system itself. This is the paradox at the center of the story. A falling price, an emptying vault, 2 signals pointing in completely different directions. And when that happens, one question becomes impossible to ignore. Which signal is telling the truth? To understand this, it helps to picture 2 different worlds sitting on top of each other. The first world is the paper world. This is the world of contracts, screens, and numbers that flash red or green. It is where most people experience silver, as a price, a chart, a percentage change. This world moves fast. It reacts to interest rates, to currency strength, to decisions made in boardrooms thousands of miles away from any mine. The second world is the physical world. This is the world of actual metal, bars stacked in vaults, coins in vending machines, silver soldered into solar panels and circuit boards. This world moves slowly. It cannot be rushed. A mine cannot suddenly produce more silver just because someone wishes it. The metal exists or it doesn't. For most of the time, these 2 worlds move together. The paper price roughly reflects what's happening physically. But every so often, they pull apart. The paper world races ahead in one direction, while the physical world quietly moves in another. That is exactly what appears to be happening right now, and history offers a warning here. Whenever these 2 worlds separate for too long, something eventually forces them back together. It doesn't happen gently, it happens suddenly, a sharp, fast correction that catches most people off guard, because they were only watching the price, never the vaults. Somewhere in a warehouse in New York, ounce by ounce, ton by ton, silver is leaving. Quietly, without a headline, without a press conference. The people withdrawing it are not doing so by accident. Large, coordinated withdrawals of physical metal do not happen on a whim. They happen when someone, a bank, a fund, an institution with access to real information, decides that owning the actual metal matters more than owning a promise on paper. And that raises the real question this story is built around. If the smartest players in the room are quietly securing physical silver while the price falls, what exactly do they know that the rest of the market hasn't figured out yet? To understand why the vaults are emptying, it helps to go back further than most people bother to look. Not 8 months, not even a year. 6 years. Because what is happening right now did not start last week. It started in 2021, and it has been quietly building ever since, almost unnoticed, like a slow leak in a boat that nobody checks until the water is already at their ankles. Here is the number that changes everything. Since 2021, the world has pulled over 750 million ounces of silver out of its above-ground stockpiles, just to keep up, just to meet demand. Every single year, for 6 years straight, the world has used more silver than it has managed to dig out of the ground. Picture a savings account. Every year, more money leaves that account than gets deposited into it. At first, nobody notices because the account is large and the withdrawals feel small compared to the total. But 6 years of steady withdrawals, without matching deposits, eventually hollows out even the biggest account. That is what has been happening to the world's silver stockpiles. And here is the twist most people never expect. This year's shortfall is not smaller than last year's, it is larger. Roughly 46 million ounces larger demand than supply, compared to about 40 million the year before. The gap is not closing, it is widening. Now, a reasonable person might ask, why doesn't someone just mine more silver? If the world needs it so badly, why not increase production? This is where the story takes an unexpected turn. Most people assume silver mines exist because companies go looking for silver, but that is rarely true. Roughly 3 out of every 4 ounces of silver pulled from the earth come out as a side effect of mining something else entirely: copper, zinc, lead, gold. A company digs for copper because copper is what pays the bills. Silver simply comes along for the ride, buried in the same rock. This means something strange and important. Silver production does not respond to the price of silver at all. If silver's price were to double tomorrow, a copper mine would not suddenly decide to produce more silver. It would still produce exactly as much copper as the copper market demanded, and whatever silver came out with it, came out with it. Nothing more. The supply of silver, in other words, is almost frozen in place. It cannot flex, it cannot respond. It simply is what it is, year after year, regardless of how desperately the market wants more. Meanwhile, the demand side of the story is shifting in ways that surprise even people who follow this closely. Solar panel makers, once one of the largest consumers of silver on the planet, have started using less of it. Not because they want less, but because silver has become expensive enough that engineers are redesigning panels to use thinner and thinner layers of it. It is a quiet retreat, forced by cost. But as one door closes, another opens wider than expected. Electric vehicles, artificial intelligence data centers, and next-generation electronics are now demanding more silver per unit than the technologies they are replacing. Silver conducts electricity better than almost anything else on Earth, and in a world racing to build faster chips and bigger data centers, that property has suddenly become valuable in ways nobody fully priced in a few years ago. So here is where the story stands. A supply that cannot grow, no matter how high the price climbs. A demand base that keeps finding new reasons to need more silver, even as old uses shrink. And 6 straight years of drawing down stockpiles that were never unlimited to begin with. This is the machine running quietly underneath the emptying vaults. It has been running for 6 years, in full view, reported in industry data that almost nobody outside the metals world ever reads. And it raises an uncomfortable question. If this shortage has been building for 6 years already, how much longer can a falling price possibly last before the physical world runs out of quiet ways to hide it? If the vaults are emptying and the shortage is real, then something else has to explain why the price fell at all. And the answer to that question does not live in a mine, or a warehouse, or a solar factory. It lives in a single press conference, held by a single man in a room in Washington. His name is Kevin Warsh. He is the new chair of the Federal Reserve, and when he stepped up to the podium for his very first appearance in the role, almost nobody knew exactly what to expect. they found out within minutes. Wersch used one phrase over and over, 12 times in a single press conference. Commitment to price stability. 12 times. That is not something a person says by accident. That is a message repeated so many times that no one in the room could possibly misunderstand it. The message was this: interest rates are not coming down anytime soon, and they might even go higher. Here is where the story takes its strangest turn. This single event, one man, one press conference, one repeated phrase, did something that 6 years of physical shortage could not do. It pushed silver's price down. To understand why, imagine two competing forces. On one side, a slow-moving physical shortage that has been quietly draining stockpiles for 6 years. On the other side, a fast-moving financial current made of expectations, probabilities, and trading algorithms that react in seconds, not years. When Wersch spoke, that financial current shifted instantly. Traders began pricing in a much higher chance of an interest rate hike later this year. And when interest rates rise, or are expected to rise, something curious happens to metals like silver. Silver does not pay interest. It does not pay a dividend. It just sits there, waiting. So when a savings account or a government bond suddenly offers a guaranteed return of 5 or 6%, silver starts to look less attractive by comparison. Why hold something that pays nothing when something else nearby is now paying handsomely? At the same time, higher rate expectations made the US dollar stronger. And because silver is priced in dollars around the world, a stronger dollar quietly makes silver more expensive for buyers in other countries, even if the number on the screen hasn't moved. Less foreign buying, more domestic selling pressure, the price begins to slide. This is the financial world reacting to a man's words, not to the actual physical availability of silver. It reacted in hours. The vaults, meanwhile, had already been emptying for months. And here lies the twist that separates people who understand this market from those who only watch the headlines. The falling price has almost nothing to do with the shrinking vaults. They are two entirely separate stories, running on two entirely separate clocks. One clock, the financial one, moves in days. The other clock, the physical one, moves in years. Right now, the financial clock is temporarily louder. It is drowning out the slower, quieter signal coming from the warehouses. But louder does not mean permanent. Every technical chart tracked by major trading desks right now shows the same thing. Silver, sitting in oversold territory, pushed there by financial selling that has little to do with actual scarcity. Support levels have been tested and broken. Moving averages have flipped negative. On the surface, everything looks bearish. Yet underneath all of that technical noise, the ratio between gold and silver has climbed to a level rarely seen outside of major turning points in history. Every time this ratio has reached similar territory in the past 50 years, one metal eventually moved to close the gap, and it was almost always silver that made the larger move. So now two clocks are ticking side by side, one driven by a man's words in Washington, the other driven by ounces disappearing from a warehouse in New York. They cannot both keep pointing in opposite directions forever. And when a financial clock and a physical clock have been running against each other for months, something eventually has to force them back into sync. The only question left is what that moment looks like, and who gets caught unprepared when it arrives. Every story like this eventually arrives at a moment where waiting is no longer possible. That moment, for silver, is closer than most people realize. Two dates sit on the calendar ahead, and between them they will decide which of these two worlds, the paper world or the physical world, finally wins. The first date is a jobs report, a routine government release, the kind that flashes across financial news for an hour and is usually forgotten by lunchtime. But this particular report carries more weight than most, because it lands directly in the middle of the storm created by the Federal Reserve Chair's hawkish words. If the jobs numbers come in strong, if the labor market looks healthy and resilient, it hands the Federal Reserve exactly the excuse it needs to raise interest rates again. The dollar would likely climb higher, and silver, still caught in the financial current, could be pushed down even further, toward levels not seen in months. But if those numbers disappoint, if hiring slows and cracks begin to show in the economy, the entire narrative flips. Suddenly, the case for raising rates weakens. Traders would begin unwinding their bets, the dollar would soften, and silver, freed from that pressure even briefly, could snap upward with surprising speed. One report, two completely different futures. And nobody, not even the largest banks in the world, knows for certain which way it will break. The second date arrives weeks later, an inflation report, tracking the Federal Reserve's preferred measure of rising prices. This one carries a twist of its own. In the months leading up to it, oil prices had fallen sharply, dropping by more than a third from their earlier highs. Lower oil prices tend to ripple through an entire economy, quietly cooling transportation costs, energy bills, and the price of nearly everything that has to be shipped or manufactured. If that cooling effect shows up clearly in the inflation data, it could hand the Federal Reserve a reason to step back from its aggressive stance. And if the Fed steps back, the entire chain reaction that has been pressuring silver, higher rates, stronger dollar, weaker metal, could begin to reverse itself. This is where the real tension of the story lives, not in a single moment, but in a narrow window of a few weeks, where two government reports will either extend the financial pressure on silver or break it completely. And underneath all of it, the physical story never stopped moving. The vaults did not pause while traders waited for economic data. Ounces continued leaving. The 6-year shortage continued widening. None of that depends on a press release or a government report. It simply continues, quietly, regardless of what the headlines say on any given week. This is the uncomfortable truth sitting at the center of everything. The financial world can push a price down for weeks, even months, based on expectations and probabilities. But it cannot manufacture silver that does not exist. It cannot refill a vault that has already been emptied. Eventually, someone who needs real, physical metal will come looking for it and find less of it waiting than they expect. History suggests what tends to happen next. When a financial market has been suppressing a price far below what the physical reality supports, the eventual correction rarely arrives slowly. It arrives suddenly, sharply, and it catches the people who are only watching the price chart completely off guard, while the people who were watching the vaults saw it coming from months away. 2 clocks, one in Washington, one in a warehouse in New York. 2 dates on the calendar that will decide which one the market finally listens to. The vaults have already made their decision. The only remaining question is how much longer the price can pretend otherwise, and who will still be watching when the two finally collide.